Welcome to the Explainer. So, picture this. It's July 4th, 2025. Right in the middle of Independence Day fireworks, the U.S. government officially signs the biggest tax overhaul we've seen in 8 years. They're calling it the One Big Beautiful Bill. And let me tell you, it is literally a 1,000-page beast of a document that almost nobody has actually sat down to read. I mean, who wants to spend a holiday weekend translating tax code, right? But because of all of the legal jargon and the political noise, most folks are sitting there with absolutely no idea what's actually in this thing, or more importantly, how it's going to hit their bank accounts. Well, we are going to fix that right now. We're going to cut through the noise and translate this massive piece of legislation into real, actionable money moves.
Now, really quick before we dive into the weeds here, I have to make something crystal clear. Everything we cover in this explainer is strictly for educational purposes. It's not tax advice, and it's definitely not financial advice. As you're about to see, tax laws are incredibly complicated. Income limits are all over the place, and your specific financial situation is completely unique to you. So please always consult a licensed CPA or tax professional before making any big moves based on what we talk about. We good? Awesome. Let's break this bill down. To really wrap your head around the scale of what just happened, you kind of need to know why this bill even exists. Fortune magazine actually hit the nail on the head, calling it the most sweeping change since the Tax Cuts and Jobs Act back in 2017. And there's a huge reason for that. You see, those 2017 tax cuts, they were actually temporary. They were basically sitting on a timer set to expire at the end of 2025. So without this new law, your taxes were automatically going to jump up in 2026. The One Big Beautiful Bill steps in and permanently extends most of those older provisions. So no automatic tax spike for you, but then it stacks a whole bunch of brand new deductions and credits right on top.
So, here's our game plan for today's explainer. We've got 5 key areas to cover. 1. Tax breaks for workers. 2. Family and senior perks. 3. Homeowners and auto loans. 4. Eliminated credits. And finally, number 5, your 2026 action plan.
Okay, let's dive into this. Section 1. Tax breaks for workers, specifically looking at tips and overtime changes. To really get this, we've got to clear up the biggest misconception floating around out there. You've probably seen the headlines screaming about zero tax on tips. Well, actually, scratch that. It's not true. The new law creates a tax deduction, not a full-blown exemption, meaning you still have to report the income and you are absolutely still paying Medicare and Social Security on it. A deduction just means you get to shrink your federal taxable income by a certain amount before the IRS calculates what you owe.
And the magic number you need to remember for tips is 25 grand. Under this new rule, if you make less than $150,000 a year, you can deduct up to $25,000 of qualified tip income from your federal taxable income. To put that into perspective, let's say you're a server pulling in $40K a year in tips, and you sit in a 22% tax bracket. Taking that $25,000 deduction could save you up to $5,500 in federal taxes. That is real, tangible cash staying right in your pocket.
But wait, let's compare that tip deduction to the new overtime deduction, because the rules are pretty specific. For tips, to get that $25K deduction, it has to be a genuinely voluntary tip, and you have to work in one of 68 qualifying job types. If a restaurant slaps an automatic gratuity or a mandatory service charge on a large parties bill, yeah, those totally do not count. Now, over on the overtime side, workers can deduct up to $12,500 of qualified overtime pay. But there are income limits. It phases out if you're single making over $150,000 or married making over $300,000. And a huge heads up here, both of these perks are temporary. They're actually set to expire in 2028. All right, moving right along to Section 2, the bigger standard deduction. This is your new permanent baseline. Take a look at these numbers, because for the 2026 tax year, the standard deduction got a massive facelift. Single filers, you're at $16,100. Heads of household are up to $24,150. And married couples filing jointly get a massive $32,200 standard deduction. And the best part, this is a permanent change. In plain English, a married couple pays literally zero federal income tax on their first $32,200 of combined income. Poof, sheltered. Because this baseline is just so high now, it effectively makes the absolute headache of itemizing your taxes totally obsolete for the vast majority of us. You just take the standard deduction and go enjoy your life. Okay, Section 3. Let's talk family and senior perks covering targeted credits and deductions. So, if you've got kids at home or if you're getting close to retirement, listen up. The child tax credit has bumped up to $2,200 per qualifying child for 2026. Now, remember how we just talked about deductions lowering your taxable income? Well, a credit is way, way better. A credit is a dollar-for-dollar reduction of your actual tax bill. So if you've got 3 qualifying kids, you are knocking $6,600 straight off whatever you owe the IRS. You just have to fall under the income limits, which are $200,000 for single filers and $400,000 for married couples.
Now, for our seniors, there is this incredibly lucrative, kind of under-the-radar perk. The bill rolled out a brand new $6,000 deduction exclusively for folks 65 and older. It runs from 2025 through 2028. The income limits to get it are $75,000 if you're single and $150,000 if you're married. But here is the absolute game changer. This new deduction stacks directly on top of the standard deduction. That means a single senior can take the $16,100 standard deduction, add this $6,000 senior deduction, and completely shelter $22,100 from federal taxes before owing a single dime. If you're on a fixed retirement income, that is huge.
And for the youngest generation, the law created a brand new type of investment vehicle officially called Trump accounts. Think of them as a cool hybrid between a 529 college plan and a Roth IRA, specifically for kids under 18. You can toss in up to $5,000 every single tax year, the money grows tax-deferred, and the kid can't touch it until their 18th birthday. But here's the crazy part. The federal government is literally giving a one-time $1,000 contribution to kickstart a Trump account for every eligible American child born between 2025 and 2028.
Next up, Section 4, Homeowners and Auto Loans. There are some really big perks here if you're one of the folks who still itemizes. Remember how brutal the old SALT cap was? That's the state and local tax deduction, and used to be capped at just $10,000. If you lived in a high-tax state like California, New York, or New Jersey, your property and state taxes easily blew right past that limit. Well, the One Big Beautiful Bill quadrupled it. Starting in 2025, that cap jumps all the way to $40,000. If you're paying $30,000 in local taxes, you get to deduct that entire chunk, potentially saving you thousands in federal taxes. 2 quick things to keep in mind, though. This expanded cap shrinks back down to $10,000 in 2030, and the benefit phases out if you're making over $500,000.
Oh, and there is another brand new deduction in here that is practically a hidden gem. Get this. You can now deduct up to $10,000 a year in interest on a personal use vehicle loan. Now, there are strict rules. It only applies to brand new cars, absolutely no used vehicles, and it's only valid for tax years 2025 through 2028, with certain income limits. But think about it. If you finance a new $40,000 car right now at, say, 7% interest, you're paying around $2,800 in interest that first year alone. If you're in the 22% bracket, writing that off saves you over $600. That's real money you are totally entitled to claim. All right, Section 5, Reductions and Eliminated Credits. Let's objectively look at the cutbacks.
Look, to make the math work on a piece of legislation this massive, some things definitely had to go on the chopping block to balance the books. A lot of that funding came from rolling back clean energy incentives. For example, the tax credits for buying an electric vehicle, those officially phased out back in September 2025. Home electrification credits, which were the ones covering heat pumps and solar panel upgrades, those were fully terminated by December 2025. And the credits for installing EV charging infrastructure phased out in June of 2026. So if you were planning to rely on those credits for a future purchase, you need to know that window is officially closed under this law.
And the cutbacks do extend to a few other major programs as well. The rules for health insurance premium tax credits were tightened, which means subsidies on the marketplace are stricter now, potentially reducing how many people qualify for coverage there. On the student loan front, if you get loan forgiveness through an income-driven repayment plan, that forgiven amount is now strictly treated as taxable income, which is a direct out-of-pocket tax bill for borrowers. Also, the bill implements much stricter Medicaid eligibility and work requirements, though the specifics on that will vary depending on your state.
Okay, bringing it all home with Section 6, your 2026 action plan. Let's talk about adjusting your strategy.
We've covered the massive perks, the rollbacks, and all the fine print. Let's turn this into a rapid-fire checklist so you're ready. First up, if you make tips or overtime, you need to start tracking that income separately right now. You are going to need bulletproof documentation to claim those new deductions. Second, verify your withholding at work. Make sure your employer is factoring in these new higher standard deduction brackets, otherwise you're just giving the IRS an interest-free loan. Third, if you or someone in your family is 65 or older, make sure you explicitly tell your tax prep person to grab that new $6,000 senior deduction. Fourth, high tax state homeowners, Sit down with your CPA immediately. You need to run the numbers to see if that huge 40K SALT cap makes itemizing worth it again. And finally, if you welcomed a child in 2025 or later, look into opening a Trump account right away to grab that $1,000 head start from the government. Honestly, the One Big Beautiful Bill is a total game changer. It's going to completely reshape American finances for years. The biggest mistake you could possibly make is letting a tax overhaul this massive pass by without adjusting your own game plan. So I pass the question to you. Which of these massive tax changes affects you the most? Is it the new standard deduction, the overtime perks, the cutbacks to EV credits? Drop your thoughts down in the comments below. I'd love to read them. And hey, if this explainer helped clear up the confusion, please hit that like button, share this with a friend who definitely needs to see it, and make sure to subscribe so you never miss our deep dives. We'll keep bringing you the facts. See you next time.